Good morning, everybody. Today is Thursday, somewhere around the 30th of April. It's like near the end of April, closest one to the end of April. I'm once again under the weather. I don't know how this keeps happening, but I'm just pretty tired of anything related to winter right now. And we've got like a 2-day bug that's going through our house. Hit me yesterday, so that took me out of the game. Feeling better today, but we've got appointments in the city most of the day, so no trading. But what better time to crank out some questions and answers for you guys? Hopefully, I'll get this posted today on Thursday. If not, it'll be posted on Friday or perhaps on the weekend if I wind up trading Friday. But you'll see it soon enough anyway. ADS, thanks for your question. If you do a Q&A soon, do you ever trade options on futures? Are they as liquid and leveraged as typical options like SPY and provide good opportunity for quick scalps? I don't trade options. I wouldn't try and scalp options either. It's just not, that's kind of not really what they're for. But no, I don't trade options. I just don't see the need to look at trading options on the indexes whenever you can just trade the futures contract that's got the liquidity and got the leverage and all that stuff that, I guess I can't see any advantage for me anyway. So no, I have some knowledge of options. I've learned about them. I've studied about them. Never tried to trade them because I just haven't found the need to. Andrew Wilson, first time commenter. Thanks for your comment, Andrew. Question about news. He said, for instance, this morning, the day that he wrote this, U.S. Fed speakers said that interest rates might go higher than originally thought. Said he's only sim trading, but that news move kind of told him not to trust any pullback throughout the day. All that being said, how much do you watch the news when trading? And did you hear about that morning as well? Yes, there's an awful lot of. First of all, I will always screen before I touch the computer, before I even open see or chart. I will look at a news feed to see what's coming up this morning. I like the Financial Juice page because it's really nice. I get real-time news from them, but you can get delayed for free. And there's also forexfactory.com/calendar. That was the old one I always used to use for years and years before Financial Juice came out. It's excellent too. It's geared mainly towards currencies, but all the major announcements that affect the futures are on there. The nice thing with Financial Juice is you can create your own sort of custom watch list for news, or just quick ones you can just type or like click for futures, index futures, whatever, anything related to that will automatically come up. It's all color coded on both of them. Red news is essentially what I'll look at. Now, any red news, I'm going to be out of the market during that news. If I trade it, I will fade it for the most part. That's generally the best trade if you want to trade the news like that. If you want to get in before it, you just have to guess, which I have occasionally done on rare occasions with very small size. But essentially, you don't know. And even one thing that we're going to test someday is try out using my real-time live paid news feed and see if it gives you the news fast enough to act on in the direction of the news move and get filled and all that. My thinking is probably not, but a fun experiment. I'm going to try that sometime. So on a free news feed, you're going to get the news, 40 seconds later or something like that, which is really no big deal for the average trader. But the thing that you're talking about, I think, was not an actual news announcement, but comments from a Fed member speaking at somewhere or for some committee or something. Those things are also all published, and anytime there's a Fed member speaking, like that comes on that's usually like a yellow news. Anytime there's one of those, like I look at that before my morning, and I write it on my cheat sheet as far as whatever's coming up for this day, and I will trade over those times sometimes, but as a rule, I'd like to stay out for that. The problem is, it's great because it can cause some volatility in the market, but because the market can just move on any word that they say, it's kind of random volatility. It's not if it's moving based upon what they're saying and they're not just all pushing it one way. Oftentimes you'll see they'll say one thing, like interest rates are going to go higher than expected. Oh, the market goes down, and then there'll be some other thing, some other optimistic thing that they will say but we don't think this will last past Q2 or Q3 or whatever, or something, just making stuff up, something like that. And then the market comes back. The volatility caused by that isn't as tradable as a volatile day or a day with a good range. Caleb has a question. Thanks for your video. Percentage-wise, in relation to how well you do now, how profitable do you think you'd be if you never modified your stop loss or take profit? I don't log that now. Many years ago, like probably 7 or 8 years ago, maybe 10 years ago, even when I was really starting to get the feel of pure discretionary trading, I did log that a little bit. So what I would say, as far as my best educated guess, like I don't have any interest really in doing an experiment of tracking that now, because I don't want to change the way I trade. I'm pretty set in my ways, and I've got a reasonably good feel of the market most days. Oftentimes it will go further, but there's a lot of times when it turns right when I get out too. So my best educated guess would be that I might do about the same or a bit worse if I left that on. But, and it's a big but, and it's more important to me than the first part, unless there was a huge difference, is that the win percentage would go down significantly. A lot more stop losses hit. The winners would be bigger, but there'd be a whole lot more losses. And that's no good. I mean, it's okay if it works for you or for anybody, but for me, the most important thing is win percentage and not taking losses. Like, I just mean for my own psychological capital. So yeah, for me, the combination of win percentage and net result by doing it this way is far better than just set it and forget it. Even if you had just as good results, which I really don't think I would have, in the end of the day, the up and down in between and then taking losses and all that stuff, it's much harder to do. If you can get a good feel for the market, a good discretionary trader, good discretionary exits, to me, that's the way to go. Itai Hoffman, thanks for your question. How much do you use candle patterns and Fibonacci? Almost none. It's in my head, like it's up there, because I went through all that stuff and through the normal path that we all go through. See if there's a big news move or if there's just a big move in the day. And you want to know that I've got in my head, I know where the 618 is, right? Like it's it's something that I'll just sort of mentally draw, but I don't even want to give it quite that much, because for the most part, if there's a big move like that, 40-50% retracement is very common. I don't think it has anything to do with it being a Fibonacci number or not, because it does not go and turn right in that exact spot. It just doesn't make sense. So that's kind of my opinion on Fibonacci. Like, it's no hocus pocus secret ingredient to your trading or anything. But at the same time, I do keep it in the back of my head, doing that 50 or 40, 50% retracement, the 6 to the 50 or the 618, whatever. That's a common thing that happens. And so it's back there. As far as candle patterns, yes, yes and no. Candle patterns are there's too much emphasis put on them, I think, for intraday trading, because you can get obsessed with learning all the different candle patterns, like from a chart or something, and then, okay, this is what this means, this is what that means, and it just becomes an exercise of memorization that doesn't really translate. You got to remember that the candles are just a means of plotting price on a chart, and depending on whenever they start and finish, like especially like using tick charts like I do, they're not in a set time interval. So the actual pattern of individual candles on a 4,000 tick chart, for instance, compared to a 5-minute, it doesn't mean really this. It can mean different things. My concern is, what is price done? We use candles to record what price is done and put it into a visual representation that we can understand. I'm not looking at what this candle's doing versus this candle, or is this a bullish engulfing or bearish engulfing, or because, if you shifted that chart a little bit, you might not get that same candle, because that big engulfing candle might have already got cut off into two candles, right? Yet it did the same thing. So then it's no longer a bearish engulfing candle. It's just a green candle and then two red candles. So my concern is, what's price done? Figure it like a horizontal line on the chart where price is. Where has it gone? It went up this high, and then what happened? After that, it came back to here, and then it went up to here, then it came back to here, then it stayed there and stayed there. I'm looking at what price is doing. And when I look at the candles, I'm not looking at at this and kind of cross-referencing in my head of what pattern that is, I'm looking at it as a way of representing what happened to price. And that's maybe a different way of looking at it than a lot of people will talk about, but that's what it is. Candles are just a representation of the price movement. I hope I'm articulating this in a way that's understandable, but I'm just looking at the movement of price. We look at it as candles or as lines or whatever. An area, you can't really see that because you don't see the up and down, but there's a lot of different other types of charts that can show you the same thing. Anyway, Ryan SM's got a question. Thanks for your question, Ryan. This is on the overnight trade, which I very rarely do, as you can see, but I kind of do one for fun now and then. Have you ever trade options or sell a premium? I kind of talked about that. No, I don't. I just don't do options. Nothing wrong with options. It's just not for me. I don't see the need for me to trade options. It's not super complicated, but it's more complicated than just figuring out where price is going to go to me. Mike, have you ever experienced a black swan against you in a trade? No. Fingers crossed that's never once happened. Well, I haven't had a black swan in my favor either. So, unless you count the COVID crash, which I was the first time I'd ever had the experience of trading and being in a trade at limit up or down or anything. And I put the pedal to the metal during that. And I mean, it was an interesting feeling being short a lot more contracts than I am now at limit down. And then the market opens and then it's immediately limit down again. That was wild. I don't ever expect to have that sort of thing happen again. That's one of the reasons, though, why I like to be in and out as soon as possible, and why it's so important to me to get my risk out of the market and not, leave it overnight or leave it even for long trades during the day. Because if you're trading with a 10-point target or a 15, 20-point target, you're trading at a position size where a 100-point black swan can really mess up your account. So anyway, good question. Great question from Marvin. Have you noticed the ES price action different than usual since the whole bank crisis began happening last month? He's been paper trading successfully before that, struggled much more since. Yes, Marvin. The market is it's nothing that I haven't seen before. But the market is much shakier right now. It's a little bit more congested a lot of the time. It does move, but you get a lot. What I find is we're getting a lot of ranging around larger numbers. 4,100, for instance, that's been a big, support resistance over the last couple of years. It's a big one. And then 4,150 more recently. The price kind of gets to one of those round numbers and just takes a while to figure out where it's going to go from there, rotates around there. And I mean, we get little periods of this going throughout the years where we have a month or two or a few months where markets are just iffier in general. So it has gotten more difficult to trade for sure in the last couple of months. Will it stay that way? No, I don't expect it will. It will get better. It always does, always has. But whenever things are particularly shaky, and there's so much going on now. You've got the interest rate thing, you've got inflation, you've got the banks, and the situation in Europe. There's a lot of stuff going on right now, and you can expect things to be a little bit more shaky then. Okay, back from the city and did a little bit of work in the backyard, and it's break time, so more Q&A time. Chris Davies and VM both have similar kind of questions about worst case scenarios with your stop loss. Chris says, if I'm long with a 5-point stop and some terrible black swan happens, we have a flash crash, how much can I lose realistic worst case? VM kind of replied to that and said, well, it's $50 a point. If you got a 5-point stop, it's $250, and worst case scenario, in all likelihood, 99.9% of the time, worst case, even if it was 2 times, if you got slipped 5 points on a 5-point stop, well, then you're out 10 points, $500. And most of the time, yes, that is the realistic scenario. However, you can very easily put yourself in a much worse than that kind of situation, pretty much on a monthly basis if you're not careful. Not every month, but some of the non-farm payrolls, okay, especially those, and sometimes the inflation numbers, stuff like that, those 8:30 in the morning announcements, and then the FOMC Fed announcements. I've seen those move a lot more than that. You don't want to be in a position in those because, I don't know because I stay out of the market then, but the speed at which I see it move sometimes, it can go down 30 points instantly. And you might get filled at minus 10 or minus 15 or maybe even minus 7 or 8, but you might not. You might realistically be down 30 points in something like that. And the move itself might be a 100-point crash or a 100-point rally, more likely to be the crash though. That's why it's so important, we talked earlier about the news, to make sure you know what news events are going on and stay out of the market for those. But in my personal experience, I haven't gotten whacked really with anything like that too badly, but I think you could very easily lose 30 points or get slipped 20 or 30 points on an announcement like that if it's a big one, as it's a big move. And then going back to the original COVID crash, like when the market would be limit down and it would reopen again after a pause, they'd be limit down again in 5 seconds. So there are certain extenuating circumstances you can lose a lot more than your 5-point stop, but it's very rare that's going to happen, and you can reasonably feel safe that you're going to avoid that if you watch the news announcements and just don't stay in the market longer than you have to. VM does point out that you do have the option of it going in your favor too, and then having serious positive slippage, and yes, you do. But I wouldn't bet on that. Just stay completely out of the market over those news announcements. Buster says, you talk about cutting down your trading to an hour a day. How much time do you spend on trading as a whole then, including your homework for the day after, analyzing data, making improvements, or do you not do that stuff so much these days? I spend a fair bit of time in front of my computer, and just a tiny little bit of that is spent trading. But I do spend a significant amount of time just looking at the market. And if I am ever down just working on something else in the computer, I always have the charts up so I can see what's going on. The other thing is when you see the video start, oftentimes, like I'm down there for 15 or 20 minutes before it starts because then I go through and do my cheat sheet and all that. And I still pop down in the evening sometimes to update that and just take a look at the market. So for 1 hour spent actively trading the market or actively looking for trades, I probably spend at least another hour with research and kind of odds and ends. Haney Guitar Instruction says, I'm still struggling to figure out the best risk reward and the best stop loss. Mostly use 6 or 8 point stops with a 3-to-1 risk reward. My win rate is 17%, so I'm not profitable. I want a day trade for income, so do I do 1-to-1, 5-to-1, 2-to-1? So confusing. Excellent question, Haney. It's not a simple answer. Your target and your stop loss can't be, in my opinion, if you're going to day trade in the way that I do, you can't have a set target, set stop, set ratio. That doesn't work that way. You need to have a target that's a reasonable target for a reason, be it a recent support resistance level, be it an open high low close of yesterday, be it something for some reason, a big round number, something that you think is a reasonable place that the market's going to get pushed, or at least attempt to be pushed to. And so you need to have a reasonable target. You need to have a reasonable entry, something that's showing you that price is moving towards that target. Ideally, a way you can get in at a little bit better price than whenever you determine that it's moving that way. And your stop loss has to be somewhere on the chart that makes sense. It has to be around some kind of protection or around some level that has some structure on the chart. So you can't just do 1-to-1 or 2-to-1 or 3-to-1. It depends on the trade. So then we need to have a target, the reasonable target that is a spot where we expect price to test, in the next short while. We need to have a stop where that makes sense on the chart, some form of structure, a protection that we can use and put our stop loss just around that a little bit. And then we need a reasonable entry that looks like we're determined that price is most likely going this way and we want to try and get a little better price. So if I can find all those things, put them together, where my target is at least 2x what I'm going to have to risk, I will generally take that trade. However, I very often do not get 2-to-1 on the actual trade. That's a big part of the reason why it's like that. If it doesn't go all the way to my target, often it will. But if I encounter enough resistance along the way, or if I just plain get too impatient, I want to be able to at least get out of that trade what I risked. at a bare minimum. If the target is at least 2x what the stop is, then generally I will take it, fully anticipating that I may only get 1x or 1.5x out of it, but I still have a reasonable probability of hitting my target, so that if it doesn't go there, I got a much higher probability of at least getting 1-to-1. That to me is the most realistic way to look at this. If you just put on 3-to-1 trades and leave them, your win percentage is always going to be awful. You might be profitable if you're really good at it, and you pick enough good trades. Like a strategy like that, if it's 3-to-1, you don't really expect a positive win rate. If you're 50-50, you make money, handily, right? But what most often happens is, especially if it's a kind of a set it and forget it approach, your win rate's going to be 10% or something quite low. You got squirrels. Vincent Toll or Vincent Tolle. Hey Matt, thank you for your valuable content. Well, thank you for watching. I'm glad you enjoyed it. Notice the ES is about 20 points below the actual index. Same for the NASDAQ, which is 100 points below the index. When trading around key levels, could this make a difference when the actual key level is 100 points off? Could you explain how I treat that? Good question. Now, keep in mind that the futures contract is not a contract for the price of the ES right now. It's a contract for the price of the ES in June, right? So it's very rarely, it doesn't, sometimes it is, but it's usually higher or lower than where the market is right now, because it's based upon anticipation of what it's going to be like in the future. As far as plotting the actual levels and stuff, I don't pay any attention to the underlying. I'm charting the instrument that I'm trading. I'm trading the futures, I'm charting the futures, I'm finding the levels on the futures, because most people that are day trading the futures like this, they're looking at the ES chart. If they have the catch index open, they're probably just looking to capture little movements in between to see if there's a trend in the cash that sometimes will quickly catch on to the futures. That usually happens quite quickly now, but there still is enough of a difference. Sometimes you can catch it, but it's often not enough to get into a trade, but it might be something to keep you in the trade, for instance. So I pay very little attention to the exact levels on the underlying. Michael Mayan says, I think the ES stands for extra slow. Yes, lately it has had some seriously extra slow days. Music Maker Com. Got a question about the crazy day. This is a week or so ago, I think. And it's a great question. What does AMP charge me if I make about 20 quick trades today? I know I made about $16 after all that trading. Wondering how much it costs to make the 20 or so trades if you trade live. Let's just very quickly figure that. Now, I don't have it right in front of me. Perhaps I should, but I'm outside. The commissions, I think, are about 2/3 of a tick. Okay? So your tick is $1.25. I think it's around 80 cents. So say it's 85 cents. 85 times 20 trades is $17. If you made 16, you spent 17 on commissions, you're breaking even. You're not making money. Now for the mini, the commissions are about half. So say if you're trading the mini and make $170, and you got 20 trades times 380 times 20, $76. Well, then you've made $100, right? So, because the commissions are half, but it's still not really enough. You need to ideally keep the number of trades down. Look for the better trades if you can. If you take a whole lot of trades for really tiny wins, the problem is every time you do that, you've got a full risk on, and it's kind of a difficult thing to long-term succeed at. If you can cut your trading down to like 2 or 3 trades a day and clear maybe 5 points in a day, the commissions are pretty much inconsequential. And one more from Simon's. I don't actually have this whole question on here, unfortunately, because I have a screenshot. You mentioned targeting the previous day's close. Can you elaborate on that? There are times it's more or less favorable, relevant, etc. I love to target the previous day's open, high, lower, close, whatever's closest to where price is. If price is the opening the next morning and moving towards there, then that's kind of where I'm going to target, because price likes to go back to places it's recently been. And traders remember the levels of yesterday. So it's not like automatically it's going to go there. It's if I have a hypothesis price is moving in that direction, where do I think it's going to stop, or at least encounter some resistance, or get as far as? It's probably going to be one of those levels a lot of the time. Either that or one of the horizontal levels I draw on my chart often they're one and the same. You know, it's not just an automatic. It's if the price looks like it's going that way, then that would be a place that I would pick for a target as a destination, because a lot of other people are going to be looking at that, and the market will tend to get pushed towards that. It doesn't do it every day, but it very often does. If price is already moving in that direction and it's going to go that way, it will usually stop at one of those levels, resist, turn around, or at least resist at it. Okay, one more quick question from Badrul Hussein, and I guess it's something worthwhile revisiting. For those of you who maybe haven't seen it, it's another video I talk about it. What's your max? Do you have a max loss per day? And what do you do to avoid it after taking a loss or two below the max loss limit? It's been a long time since I've hit my max loss, like it's years now, but it's there and it will definitely hold. My max loss is 10 points a day, and the reason that is because I have a reasonable expectation that I can make it back the next day. I will never, ever allow myself to take more of a loss on a day than I can make up the next day. On the off chance that I take a max loss and then a second max loss, 20 points, that's it for the week. Nothing. That's it. And I will come back the next week and start over. But I find it really important to keep that number super low, because there's nothing worse than coming back the next day with a huge hole to dig out of, or like an account that's down 50%, which of course you have to double it to get back to break even, and that's when you feel like just giving up, or you know that you can have a really fantastic day and you're still just going to be a few shovels back into your hole. Like it doesn't, it's no fun. It's no good. It's really hard to resist that. You know, everybody at some point or multiple points digs himself a huge hole like that. Best advice I can give: implement a small max loss and stick to it perfectly. Anyway, guys, keep your questions and comments coming. Grab my cheat sheet newsletter, daytradernextdoor.com. And thanks so much for watching these. I really enjoy making these. It's something kind of different for me. Lets me have a little fun, get outside. So have a fantastic day. I'll see you again soon.